There's one particular stock that has been on my watch list for a couple of years now, but I've never really looked into the company because of one major reason: overvaluation. The stock has always traded at a large premium, which is why I avoided the stock entirely. However, due to recent events, the stock crashed by more than 40% in a matter of days, which got me very interested in the company. My name is Riyado, and this channel is all about finding the companies of tomorrow. And the stock that I'm talking about is Adyen, which is going to be the topic of today's video. I'll be covering the company's financials, valuation, why I'm considering buying the stock, and more. And with that out of the way, let's jump right into the video. Some of you might never heard of Adyen before, but basically the company is a global payment processor founded in the Netherlands, and it provides an end-to-end platform for merchants to accept a variety of payment methods across e-commerce, mobile, and point-of-sale applications. As you may know, the payment ecosystem is very complex, as you can see right here, which traditionally leads to a lot of problems for merchants, such as uncertain processing fees, inconsistent reporting, and rejected payments. So Adyen solves these issues by offering a single, modern, simple platform for merchants to accept payments, and as you can see, the company basically deals with all the complex back-end stuff, while merchants can focus on more important things like selling more of their products and services. By partnering with Adyen, merchants enjoy a full suite of payment solutions that cover the entire spectrum of the payment ecosystem, including both the issuing and acquiring side of the payment ecosystem. As a payment processor, Adyen generates the majority of its revenue from settling and processing payments. As you can see, pricing is very transparent, where Adyen charges a flat processing fee of about 0.11 euros per transaction, plus a percentage of the transaction volume or fixed fee based on the type of payment method used. The company also sells POS devices as well as other value-added services such as foreign exchange fees and card issuing services, but they make a tiny portion of revenue. But overall, Adyen offers three main products or operates three main segments. And the first segment is digital, which is Adyen's bread and butter. And with Adyen, merchants can accept payments online, including debit and credit cards, digital wallets such as Apple Pay and PayPal, as well as buy now pay later companies such as Klarna. Adyen also offers a wide range of in-person POS solutions, and together with its digital solutions, we have Adyen's unified commerce segment, which basically enables merchants to accept payments both online and offline, all within the same platform. And finally, Adyen also offers Adyen for Platforms, which allows merchants to embed financial products into their platforms. In short, these three commercial pillars make Adyen the one-stop shop for modern-day payment processing, which is why the company is trusted by many leading brands such as Uber, McDonald's, Microsoft, and more. By the way, I wrote an article about Adyen as well, where I cover much more detail about the company and its competitive advantages. So if you're interested, you can find the link to my article in the description box below. Let's now look at the financials of the company, and keep in mind that Adyen reports biannually rather than quarterly. With that said, total process volume or TPV was 768 billion euros in 2022, which is up 49% year-over-year, and in H1 it was 426 billion euros, which is up 23% year-over-year. So the growth in TPV over the last few years was primarily due to the company's land and expand strategy, whereby existing customers drove more than 80% of the company's growth. Such a high contribution from existing customers was due to the company's super low volume churn of less than 1%, and this trend has been consistent since the company went public in 2018, so this shows incredible stickiness and high switching cost modes within the platform. Nevertheless, we can see that growth has been slowing down, most likely due to tough year-over-year comps, as years of growth has been pulled forward due to the pandemic. Pricing competition is also a factor to the slowdown, which I'll talk more about throughout the video. Moving on, we can see how TPV is broken down by its three commercial pillars, namely digital, unified commerce, and platforms. And as it stands, digital volumes remain the bulk of the company's TPV at about 63% of TPV in H1, with digital process volume of 267 billion euros, which is up 23% year over year. Unified commerce is doing better, which is up 36% year over year with a process volume of 109 billion euros in H1. This segment represents 26% of TPV, and most of its growth was due to the robust growth in POS volumes, which grew 49% year over year to 67 billion euros in H1. And finally, platforms volume was 50 billion euros in H1, which only grew by 3% year over year, making up only 12% of TPV. The chronic slowdown in this segment was due to eBay, which accounts for the majority of its volume in the platforms pillar. For context, eBay's gross merchandise volume dropped 2% year over year in Q2, so excluding eBay, platforms will have grown 82% year over year, which is just remarkable. That said, notice the slowdown across all the segments, which is expected as the company grows over a larger base. Moving on, Adyen generates the majority of its revenue from settling and processing payments, which correlates with TPV. So net revenue was 1.3 billion euros in 2022, which is up 33% year over year, and in H1 it was 739 million euros, which is up 21% year over year. And this increase is due to the increase in TPV. But as you can see, net revenue has been slowing down, and you may have noticed that net revenue growth of 21% is slower than TPV growth of 23%. And this is due to lower take rates, which is the average percentage that Adyen collects for each transaction the company processes. As you can see in this chart, take rates has been trending down over the last few years, with take rates at about 0.173% as of H1, which is down slightly from H1 last year. And the decline in take rate is largely due to existing customers growing within Adyen's platform, whereby customers get charged lower price per transaction as they generate more volume on Adyen's platform. But while declining take rates look negative on the surface, it's actually a good thing, as it means that Adyen is growing with its customers, which at the end of the day is what Adyen wants. Looking at revenue by geography, we can see that Europe, Middle East, and Africa make up the majority of revenue, and that's not surprising since Adyen was established in Europe. But if we look at North America, we can see that this part of the company is decelerating meaningfully, and one reason for the slowdown in growth in North America, and the rest of the world for that matter, was due to the fact that the company was slow to grow its team, which limited operational expansion. But the bigger reason for the deceleration in the North American market was due to price competition, and this caught a lot of investors by surprise because North America used to be the company's fastest growing market, and to see decelerate to just 23% year-over-year growth in H1 probably bothered a lot of investors. But even with competitive pressures in North America, management refuses to sell themselves short and join the price war, as they believe that they have the best financial product out there, and if customers want quality, they would have to pay more for it. So basically, there's no compromise, and I think that's the right strategy moving forward. Regardless, I still see massive growth opportunities for Adyen as it positions itself as one of the most complete payments platform in the emerging fintech industry. At the same time, Adyen has a high quality client base, and its volume churn is basically non-existent, which speaks volumes about its technology moat. In addition, I like that management stood their ground and not resort to price cutting, and this strategy reflects strength within the business, confidence among management, and differentiation in the platform. But moving on, Adyen has a highly profitable business model. In 2022, operating profit was 665 million, representing a 50% operating margin, and keep in mind that this is not adjusted for stock-based compensation or any other unusual costs, which many high-growth tech companies do. So a 50% margin is just incredible in my opinion. However, in H1 this year, operating profit was 279 million, with operating margin declining to to 38%, and as you can see, operating margin is in a downtrend, and this is due to aggressive hiring in the past year as the company prepares for the next stage of growth. As you can see, wages and salaries grew 92% and 83% in H2 last year and H1 this year respectively, bringing wages and salaries to 33% of revenue, up from just 22% a year ago. The company added 551 full-time employees in H1, bringing the total to 3,883, which is a 17% increase from H2. Now that is a lot of hiring, but this should moderate heading into 2024, and consequently, we should see operating margins improve as the company regains operating leverage. But despite all the hiring, Adyen still maintains strong bottom line numbers in H1 with net income of 282 million at a 38% net income margin and EBITDA of 320 million, which is a 43% EBITDA margin. Of course, margins are not as high as they were, but the company is reinvesting for growth by expanding its team and improving the platform, which should pay off in the long run. Instead of turning cautious like other tech peers, and instead of optimizing profitability for the sake of satisfying shareholders in the short term, Adyen chose to be aggressive with expansion, which sets it apart from other competitors. That said, Adyen is a highly profitable business with high earnings potential, and when hiring stabilizes, the company should regain operating leverage, which should see margins improving in 2024 and beyond. Turning to financial health, Adyen has a very strong balance sheet. The company has 6.4 billion euros in cash and short-term investments with 0.2 billion euros in total debt, which puts its net cash position to be about 6.2 billion euros. Its cash hoard is very large, with net cash representing more than 25% of its market cap of 24 billion euros today. And Adyen is not just highly profitable, but it's also a cash-generating machine. In H1, Adyen generated a free cash flow of about 248 million euros at a free cash flow margin of 34%. Adyen has historically produced high free cash flow margins of over 50%, but as you can see, free cash flow margins are falling due to, again, accelerated hiring as well as front-loaded capex for infrastructure investments, which was 7.6% of net revenue in H1. Again, the company is investing very heavily for future growth. That being said, Adyen is super capital efficient as well, with an ROIC of more than 20%, as you can see by the red purple line right here. Although not as high as Visa or MasterCard, Adyen's ROIC is still higher than most fintech peers such as PayPal and Block. I love companies with a high ROIC of at least 20%, which is a trait among long-term compounders, and given its consistent track record of high ROIC, I don't mind Adyen spending some cash and sacrificing margins in the short term to fuel long-term growth. In terms of outlook, management reiterated their long-term financial objective, stating that they don't see any developments that change their long-term or medium opportunity in H1, despite some areas of the business decelerating in growth during the period. That said, net revenue growth is expected to be between the mid-20s and low 30s in the medium term, and given the recent investments that the company made recently, I won't be surprised if growth re-accelerates in 2024. Long-term EBITDA margin is expected to increase to levels above 65%. Once hiring slows down, the company should regain operating leverage, with EBITDA margins returning above 60%. And finally, CapEx is expected to be at levels of up to 5% of net revenue. It's worth mentioning that Adyen has a capital-light business model, so I don't see CapEx exceeding 5% for long periods of time. Whatever it is, Adyen still has a long growth runway ahead as the leader in modern payment processing. According to JP Morgan, approximately $54 trillion of payment volumes flow through 5 mega themes: platforms, online, wallets, embedded, and real-time transactions. With a TPV of just 848 billion euros in the last 12 months, Adyen has roughly 1.6% market share, so there's a lot of room to grow for Adyen. And according to a McKinsey report, all that volume could translate to $3.3 trillion of global payments revenue by 2026, so there's a lot of money to be made for Adyen. According to EY, embedded finance Adyen's adoption will grow exponentially over the next few years to $6.5 trillion by 2025. So as you can tell, Adyen is still in its early stages, and that's why they're investing heavily to capture the massive payments industry. Turning to valuation, the problem with investing in Adyen stock was that the stock was incredibly expensive. As you can see, Adyen has been trading at an EV to EBITDA multiple of more than 50 times ever since the company went public, with a peak multiple of almost 200 times and an average of 97 times, which was incredibly expensive. But the keyword here is was. As you may know, the stock plunged by 40% following H1 results due to pricing competition, slowing growth, and falling margins, and this sell-off suddenly made the stock much more reasonably valued, now trading at just 22 times EV to EBITDA. In short, Adyen has never traded this cheap before, and I think it offers great value for investors today. Now let's take a look at my DCF model, and keep in mind that Adyen calculates free cash flow by taking EBITDA minus capex and lease payments instead of the traditional formula, which is usually cash flow from operations minus capex. In my DCF model, I will modify Adyen's free cash flow calculation method slightly by subtracting income tax expenses, and that way the numbers will reflect a more accurate representation of the company's free cash flow. That's it. Here are my key assumptions, and as always for revenue growth, I will follow analyst estimates for the first 3 years and then drop growth rates gradually to just 12% by 2032. For operating expenses, I expect them to remain elevated over the next few years as Adyen continues to hire more people, but over time, I do expect operating expenses as a percentage of revenue to decline as the company regains operating leverage. Income tax expenses will be set at about 20% of operating profit, which is consistent with the past few years. Depreciation and amortization will be set at 4.5%, SBC will be set at 1%, and capital expenditures will be set at 5% of revenue as guided by management, and finally, lease payments will be set at 1.5%. So based on all these assumptions, I expect revenue to be about 7.4 billion euros in 2032 at a free cash flow margin of 43%. And remember that management guided a long-term EBITDA margin of 65%. Take that figure and minus capex and lease payment, we get a free cash flow margin of roughly 58 to 59%. Minus a 20% income tax, we get a free cash flow margin of 47%. So my projection is actually more conservative at just a free cash flow margin of about 43%. That's it. Using a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at a fair value estimate of about $11.81 for Adyen, assuming a $1.08 euro to USD currency conversion rate. And based on the current price of $8.36, this represents an upside potential of about 41%, so the risk to reward looks really good in my opinion. It's also important to look at Adyen's stock price with some context as well. For instance, in the past 5 years, the stock basically gave zero returns despite the company growing EBITDA and net income by more than 100%. So I think the recent sell-off that we've seen is just not justified, and I think the best time to buy a stock is when there's an overreaction to the downside, and we just saw one, so I believe this presents an excellent buying opportunity for investors. Now before I wrap up, let's talk about one major risk with investing in Adyen. As highlighted by management, Adyen is experiencing price competition in North America, and I think PayPal is one of the major reasons for the pricing pressure. Although popular for its branded checkout buttons, PayPal also has Braintree, which is its unbranded payment processing business, very similar to Adyen. As mentioned earlier, Adyen grew TPV by 23% in the first half of this year, but on the other hand, PayPal's unbranded processing business and Braintree grew by 30% in both Q1 and Q2, which means PayPal is growing faster in that field and taking market share away from Adyen. And by the way, I recently did a video on PayPal as well, so you can check it out by clicking the link in the description box below. Having said that, Adyen also faces tough competition from legacy processors like Fiserv, modern issuer processors like Marqeta, as well as POS solutions like Square. And if growth continues to slow down, it may be a sign of intense competition, which may force Adyen to cut prices, thus leading to declining margins, which the markets will not like. And because of that, we may not see the company deliver its financial objectives, which can lead to a loss of confidence among investors. Or worse, management could drop their long-term targets, and that could lead to another sell-off. In conclusion, Adyen is one of the most vertically integrated payments platform, and being the top dog in the industry, the company is well positioned to be the front runner in the fintech revolution for years to come. Adyen has robust growth potential, high profitability, and a strong balance sheet, and that should protect the company from short-term headwinds such as pricing competition and a challenging macro environment. The stock was previously priced to perfection, but following the 40% price plunge after the earnings results, the stock seems to be trading in undervalued territory with a wide margin of safety, which is why I will be buying Adyen stock after I upload this video. With that being said, what do you think about Adyen's post-earnings sell-off? Are you buying this massive dip? Please let me know in the comment section down below. Otherwise, that's all that I have for you today. If you find value in this video, please leave a like, comment, and subscribe to my channel for more content like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next video.